Hello and welcome again. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is June 15th, 2021, and we're going to talk about what markets are paying attention to, what we here at Blanke Schein Wealth Management and our investment committee, how we think about the market and what we're paying attention to, so you should be too. So thanks for watching. So who's ready for some popcorn? Tomorrow, you better get it ready, because tomorrow we could see some major movement in the both fixed income and equity markets by way of the Federal Reserve once again. It's their June two-day meeting. They kick off tomorrow, Wednesday. And it's going to be very interesting what they say, and more importantly, what they don't say in the post minutes being released of the press conference, if you will. And so Federal Reserve Chairman Jerome Powell has a lot to sort of in the last 15 to 30 days since all the Federal Reserve chairman and all the Fed heads across the United States of respective central banks in the respective areas regionally have been giving speeches and talking about it. What that ultimately means and translates into is the Federal Reserve has provided stimulus and a backstop in liquidity to the markets by way of $120 billion of purchases on a monthly basis in the fixed income market. That's creating sort of lower interest rates. It's providing liquidity and some certainty that the Federal Reserve is going to make sure that the markets are moving along nicely since the last 15 months of this global pandemic. And as the economy reopens. Now, keep in mind, the Federal Reserve has two mandates, a dual mandate, if you will. One is basically staying ahead of inflation. And if you know anything, from the grocery store to buying a car recently and everything in between, simply because we had the economy shut down, global production around the world from industrial production has been cut off, and then you have more stimulus than you've ever seen from governments here and around the world, and everyone's been cooped up and hasn't been able to get out and spend, and now everyone's getting out and now spending. The U.S. consumer is actually using those dollars. How do we know the U.S. consumer has dollars? As evidenced by the M2 money supply. It's the largest and highest, as high as 27% in history that it's been ever reported. And all that reports is the money that's in the banks for the consumer, as well as for small businesses, if you will. So we know that round of stimulus, or several rounds, plus lack of spending, because you couldn't really go out and spend too much, has really built up that stockpile of money for the U.S. consumer. That meets the supply and demand. You have too fewer goods, too many dollars chasing too fewer goods, right? So if you're buying a washer and dryer, it's been backed up. If you're buying a car, even the chip supply, or even video games, it's all been backed up because the world shut down. Now it's reopening, and all of this demand is being pulled forward. And so that's spiking inflation. We're seeing commodity price inflation, housing inflation. We're seeing equity markets and a few others inflation. It's a reinflation trade, as we're seeing. What the Fed says tomorrow and what they don't say probably is the most important. The Federal Reserve Chairman has been talking about pulling the stimulus back, tapering the bond buying, if you will. Keep in mind, in 2013, when they did this, in the last crisis, the market had a tantrum. The equity market and the bond market both sold off, and it didn't like it. So the Federal Reserve we're going to find out. Now, here's what's interesting. We're going to find out if the Federal Reserve has learned its lesson from the past, right? The history. We know that markets don't repeat each other, but they do rhyme in most cases. So history is a very good guide. And tomorrow, the next 2 days, it's going to be very telling as to how the Federal Reserve handles taking the sugar high, or the money that's supporting this market, away. Because let's be honest, all the economic reports that we're seeing are coming in hot and super hot on all aspects of the economy. The other mandate, though, that the Federal Reserve is ultimately going to probably posture and sort of pivot and stay steadfast on, and we're going to listen for this, is the other mandate, which is full employment. We know, if you listen to Federal Reserve Chairman Jerome Powell, he's been very vocal about making certain that all socioeconomic scale of the United States, every income level, if you will, goes back to the January and February levels pre-pandemic, going back to 2020, if you will. That was the best in history for every socioeconomic, as well as every ethnic group, both men and women, in terms of, in every category of the economy, was really humming in all full cylinders start of early 2020. And so Federal Reserve Chairman has basically used that as a benchmark to say, we are not going to pull back the stimulus until we get back to those levels of full employment across the broad spectrum of the U.S. economy. Well, that then speaks to what they're going to say. All the economists are expecting a rate hike potentially late 2023. So we're in the middle of 2021. That gives us about a year and a half, maybe 2 years from right now. We personally believe here that probably we will see interest rates hike up sooner rather than later because the strong economy and the backdrop that we're seeing, and a potential like infrastructure bill, another round of stimulus. Now, what could slow this down? Two things: what the Federal Reserve does or doesn't say, and the tantrum that could play out, or policy shift. And we'll talk about that more on other updates for you. But policy shift means it's changing in the tax structure, right? Pulling out of the market future earnings, if you will, or even from the U.S. consumer, right? Higher taxes are going to be less to spend, and the goods and services. Let's also go to the danger zone. Now, exciting as California June 15th has opened up, and even Disneyland's opened up today, a full 100% capacity. That's a big day for us Californians here. That being said, we're looking forward to the movie theater right later this summer. In July 4th weekend, you have Tom Cruise is coming back with, yes, you heard it, Top Gun. And so Maverick and Goose and who knows, the cast of characters are coming back. That just shows that I think everyone's going to go to the movie theater to support and just opening of America with an American classic, Top Gun. But I'm taking that and I'm taking one step further, the danger zone. Here's what to watch. I talked about the Federal Reserve, and I also talked about the U.S. Treasury market because it's really important to pay attention to this. This is really sort of the give and the get and the cause and effect that we saw earlier with the bond market and the equity markets, as I've reported. Now let's watch this. This is the 10-year Treasury I put on the board here for today. And in black is the danger zone, and I'll get to that in a minute. But in red is the actual yield of the 10-year Treasury going back to June of 2020 all the way to June of 2021, so this last year. And you saw that all the way through February, we were sort of just over 1%, around 1.9% on the 10-year Treasury. And then this is when the equity market, the U.S. stock market, started selling off, when bond yields went up to 1.74%. That's a huge move in such a short period of time. That's where equity markets, stock markets sold off, and they didn't like that because now you have to now equalize all of future earnings on the market, if you will, the S&P 500 and especially technology and growth companies. So we saw that play out. And now, since we've had this sort of mid-April all the way to now, we're having the 10-year Treasury in a range from the 1.7 high, if you will, to about a 1.5, 1.48 right now. We saw the 10-year Treasury as we film this today, it's just under 1.5%. But if we keep the 10-year Treasury in this range for quite some time, that's going to limit our volatility. It's going to provide future expectations with some certainty, if you will, and therefore markets can grind higher. We're already seeing that. We saw value stock go up, companies go up, and now we're seeing growth companies go up because the 10-year Treasury goes down. Simply because of future earnings on growth companies, it's better to have a lower yield, if you will. That being said, we have balanced portfolios here at Blanke Schein Wealth Management. And so what we do is, as markets grind higher, we're taking advantage of a balanced portfolio, both growth and value, large cap, mid cap, small cap stocks, as well as some international as well. So balance is key, and that's how we play the market, even though the 10-year Treasury does its thing, even when the 10-year Treasury does its thing. So let's keep an eye on the range. And the danger zone is this black dot plot, if you will, and it's really just forecasting when rates are too high. How much is too high? It's sort of a delta and a premium built in. There's a factor built in, but the take-home point is that there is a number, and right now we're looking at anything over, when we break the 1.74% and head closer to 1.8% on a 10-year U.S. Treasury, that would be the danger zone on a go-forward basis. The equity markets aren't going to like it, and I think the Federal Reserve will have some trouble staying on top of that if it happens, and that's just going to indicate that inflation is happening, or the growth of the economy is happening, and the Federal Reserve is going to have to then change posture to help slow down the growth, i.e. raise interest rates. So I hope that sort of big story, big picture recap for you about what we believe, what we're seeing here, as well as some educational insight into the equity markets and how they react to the bond markets. Watch the U.S. Treasury as we do here, because it's going to tell you more about the direction of the stock market than any other measure. So thanks for watching, and till next time, take care.